Welcome to the Portfolio Institutional ESG Update. I'm speaking with Martina Macpherson about systemic ESG risks and opportunities of the COVID-19 pandemic. Martina presides the Network for Sustainable Financial Markets and is Senior Vice President, Strategic ESG Partnerships and Engagement with Moody's in London. Martina, where do you see the biggest risks and impact of this pandemic?
Coronavirus fears have led to a historic collapse of market and investor sentiment as uncertainty leaves the global economy teetering on the brink of a recession. With a current death toll of over 250,000 people and more than 3.8 million infections in more than 200 countries in May 2020, the global COVID outbreak has emerged as a systemic social health crisis. It threatens the well-being of the world's population, and millions of people around the world will be impacted from the resulting economic downturn. Beyond the human tragedy of coronavirus, financial markets are down and volatile, trying to anticipate the full impact.
Martina, what does COVID-19 mean for private and public investors?
Investors have replaced defensive stocks with cash instruments, and macro stocks such as healthcare and utilities have risen immediately. The VIX index, the so-called fear index, has risen to levels recently which effectively price the impact of coronavirus as second only to the global financial crisis of 2008 and 9, with several equity markets now flirting with former bear market territory, down 20% from recent highs. Governments, states, municipalities around the world are required to refocus and adapt their social efforts linked to health and safety, housing, transportation, education, communication, and cybersecurity, as well as spending and, of course, international collaboration. Key questions are being asked about the global workforce weathering this storm. The ILO estimates nearly 25 million workers may lose their jobs globally in a worst-case scenario. And recent studies have highlighted the precarious conditions of low-paid workers in the so-called gig economy. I'm just highlighting here recent research by Visio Iris. Meanwhile, some consumer companies have provided good examples of innovation and adaptation and have changed their production pipelines to provide healthcare equipment and services. So this has been highlighted in most recent research by 427.
What is the impact of the COVID-19 pandemic on the global economy and the financial services sector in particular?
Profit warnings across a broad range of sectors have been increasing, not just since the COVID-19 crisis, but steadily since 2015. This trend is anticipated to continue this year and beyond. Uncertainty surrounding Brexit and mounting global trade and growth concerns were already causing consternation even before the COVID-19 outbreak, and they're continuing to rise. Companies are reviewing how to manage widespread disruption to their operations and their supply chain. For many businesses already under pressure, the impact of this further disruption may unfortunately more than they can bear. The issue goes far beyond companies with obvious links to China. Companies in all sectors are beginning to report on the negative financial effects of the COVID-19 crisis on first quarter results. Airlines, hotels, and others in the travel and leisure sectors are coming under particular strain. Let's take a closer look at some of the economic risks and opportunities. The OECD most recently updated its economic forecasts of the coronavirus epidemic under two scenarios: baseline and downside. Both scenarios are the existing and likely future measures to boost economic activity from conditions such as tax cuts, increased public sector spending, time to pay, and time to comply measures. The difference between the two scenarios in these areas will be one of degree and of length of recovery.
How complex are the effects of COVID-19 on financial institutions in times of great volatility?
The impact of COVID-19 on financial institutions has been multifaceted. Many are experiencing a period of significant volatility and hence exposures under equity-linked or secured financing structures. This may lead in an increase in the triggering of margin calls or even defaults, as certain borrowers may have insufficient assets to meet these calls. In the more medium term, the disruption to the international supply chain may impact the ability of various categories of borrowers involved in this chain to service existing debt repayments as cash flow and normal commercial activity is impacted. A consequence of this may well be an increase in actual or potential defaults, which in turn could be expected to result in an increase in restructuring and in insolvencies. It will be important for banks to carefully and continuously monitor their debt and loan positions with these counterparties. Building operational resilience has hence become an important consideration. The FCA, in its statement on COVID-19 from the 4th of March 2020, expects all firms to have contingency plans in place to deal with major events.
What are the long-term ESG risks and opportunities of this crisis?
The speed and impact of this crisis has highlighted the interconnectedness of systemic E environmental, S social, and G governance issues, which had likely been accelerated by the onset of global warming and the destruction of biodiversity and natural habitat. Meanwhile, the COVID-19 outbreak is up and foremost shaping the way the private sector is now identifying and assessing social challenges, such as the future of work and global supply chains, with a focus on innovation, technology, governance, as well as openness and collaboration. Employers are reviewing their policies and practices linked to remote and online working, and measures to ensure that they fulfill their duties of health and safety towards their employees. On the upside, current restrictions are also enabling employers to embrace and explore new technology and business models. Operational resilience, again, is key. The widespread impact of COVID-19 is revealing a significant vulnerability in corporate supply chains and the potential for disruptions and delays linked to challenging working and living conditions that also contribute to the spread of the virus. Once deemed as a reputational and regulatory risk, substandard labor conditions are now manifesting themselves as operational issues. As previously highlighted, understanding how labor vulnerabilities and working conditions in lower tier supply chains can impact operations will become hence core to investor assessments of supply chain management oversight and business continuity.
Martina, final question. Does COVID-19 threaten the Western market economy?
At Moody's, the ESG team recently commented on the future of our society, work, and the role companies can play. Essentially, the crisis is putting the stakeholder model of capitalism to the test. Late last year, 181 CEOs signed the statement of the Business Roundtable, committing to lead companies for the benefit of all stakeholders. This includes employees, suppliers, and the community, as opposed to primarily for the shareholder. COVID-19 is hence becoming a case study of how this is implemented in practice as companies are grappling with challenging trade-offs between business resilience, employment continuity, and worker health. The decisions are a question of value and values, and businesses are under more pressure than ever to demonstrate responsible business practices. High performance along the social dimension, though, is very hard to define, let alone to measure. In a nutshell, the COVID-19 crisis remains a global and systemic challenge, but I believe we will be able to master it.
Martina, thank you for having time. This is the Portfolio Institutional ESG Update with Martina Macpherson. We have collected background information on this topic for you. If you enjoyed this interview, subscribe to this channel and visit our website.